Imagine a company tells you these financial statements are correct. The big question is, should you believe them? Well, this is exactly where auditing comes in. In this class, I'm going to be breaking down auditing in the simplest possible way. I'm going to make it simpler, practical, and easier to understand. I am Lilian, and this is AI Skills, Finance, and ACCA. Let's get started.
During the middle of the 19th century, the development of joint stock corporations required directors to report to the shareholders whose capital they managed. In earlier business models, the owner was typically the manager. Because the person funding the business also operated it, there was no gap between the recorded figures and the physical reality of the assets. As ownership and management separated, two groups emerged: shareholders, principals, and directors, agents. Capital flows from principals to agents. In exchange, directors assume stewardship over this property. They produce financial reports, but controlling both assets and reporting creates a severe conflict of interest. Shareholders are forced to rely on data provided by the very people they are trying to monitor. This creates a state of information asymmetry, where the managers always know more than the owners. For a market to function when ownership and control are divorced, the system requires a verification mechanism to ensure management's reports are actually true. This verification is driven by accountability, the requirement for one party to justify its actions and decisions to another. To enforce this accountability and resolve the tension between owners and managers, the system introduces a third party, the practitioner or external auditor. This three-party relationship connects the practitioner to management and shareholders. Between practitioner and directors, the relationship is evaluation, probing records for evidence. Between practitioner and shareholders, it's reporting, providing the independent verification needed to trust the data. This role is distinct from an internal auditor, who is an employee reporting to management. External auditors are independent outsiders, appointed to report directly to the shareholders. By involving a neutral third party, the system creates a formal structure where corporate data can be independently validated before it is used for decision-making. Every assurance engagement, from a statutory financial audit to a specialized ethical review, is built on 5 structural elements. The first is the three-party relationship we just identified, establishing the lines of responsibility between management, the users, and the practitioner. Second is the subject matter. This is the specific set of data or assertions that requires verification. To evaluate that data, auditors need an objective benchmark to determine what correct actually looks like. This leads to the third element, criteria. In a standard audit, this is the applicable financial reporting framework, such as IFRS, which dictates how data should be measured. Fourth is evidence. The practitioner performs procedures to obtain appropriate information to support their conclusion. The final element is the assurance report. This is the written communication where the auditor expresses their opinion to the shareholders. If any of these 5 elements are missing, the engagement lacks the structure necessary to provide a valid level of assurance. The operational reality of an audit is defined by how the practitioner executes that fourth element, the gathering of evidence. The process follows a systematic cycle, beginning with risk assessment. The auditor identifies areas where the financial statements are most likely to contain errors. They then evaluate the internal controls in place and perform substantive procedures, such as verifying asset existence or recalculating balances, to test the figures directly. This investigation is driven by professional skepticism, a specific psychological posture required throughout the engagement. Professional skepticism involves a questioning mind and critical assessment of evidence. The auditor must remain alert for conditions that suggest the data might be misstated. This posture assumes neither management's dishonesty nor their unquestioned honesty. It requires the auditor to look past management's representations and seek independent proof. This means being alert to contradictory evidence or bypassed internal controls to conceal fraud. This makes the audit an active investigation where the depth of testing is dictated by a questioning mindset. Despite this rigorous testing, an auditor cannot provide absolute 100% assurance that the financial statements are perfect. Practical limitations are always present. Auditors use sampling rather than checking every single transaction, and sophisticated fraud, especially involving collusion or forgery, is specifically designed to be invisible to standard audit procedures. Because absolute certainty is unattainable, assurance exists on a spectrum. The level of confidence an auditor can provide is directly proportional to the depth and type of evidence they gather. In a statutory audit, the practitioner performs extensive testing, like physical inspections, to gather reliable evidence. This depth allows for reasonable assurance. The robust evidence lets the auditor express a positive conclusion. A review engagement involves much less evidence gathering, relying mostly on analytical procedures. With a shallower pool of evidence, the practitioner can only provide limited assurance, expressing a negative conclusion. The wording of the final report is mathematically bound to the evidence. Without the deep testing of an audit, the high-level, positive conclusion of reasonable assurance cannot be legally sustained. The final physical output of this entire framework is the independent auditor's report. The report states whether the financial statements are free from material misstatement. Auditors define materiality by the impact on the user. An error or omission is only material if it is significant enough that it could reasonably influence the economic decisions of a shareholder. If the auditor is satisfied that the statements meet this threshold, they conclude that the reports give a true and fair view. True indicates that the information is factually accurate and complies with the law. Fair indicates that the presentation is unbiased and reflects the actual commercial substance of the business transactions. The report does not predict the future success of the company. It simply provides a certified declaration that management's financial report is an accurate reflection of the company's actual position. Defining materiality, weighing conflicting evidence, and forming a final opinion cannot be reduced to an automated checklist. These tasks require professional judgment, the application of specialized training and experience to reach informed decisions in complex or ambiguous circumstances. The external audit exists to bridge the gap between the principals who own the business and the agents who run it. By applying professional judgment and skepticism within this formal framework, auditors provide the independent verification necessary for corporate data to be used as a reliable basis for economic activity.
I hope that made auditing a lot easier to understand. Here on AI Skills and ACCA, my goal is simple: to make difficult accounting and finance topics practical, simpler, and easier to understand and remember, while leveraging on AI to learn and work smarter. If you find this video interesting, please don't forget to share with your friends, ACCA students, ICAN students, and all accounting and finance students, because this is just the beginning. Stay glued to this channel because we are in for a ride. See you in my next section. Love you.